If you love the master pattern methodology and are obsessed with finding different ways to use it to help improve your trading, then you're going to love this lesson. This is level 3, the master pattern advanced theory. In this lesson, I'm going to share with you 4 different ways that we at Trade ATS have used the master pattern frameworks and methodology to come up with little niche strategies and insights that we use on a daily basis. The 4 different strategies and insights I'm going to cover as examples are the following. Number 1 is intra-cycle communication. This is going to be a really interesting one. Number 2 is spotting efficient versus inefficient markets, which is really at the core of our methodology. Number 3 is order block projections. This one's really cool. You're not going to want to miss that one. And then number 4 is multi-leg expansion. These are 4 of the most predominant features that we've noticed in working with the master pattern methodology for so many years. So I think you're going to find these very helpful. But why is this so important to understand? Well, when you understand how the master pattern works as a whole, you can take certain characteristics of the pattern to form your own specific strategies and approaches to trading. We teach you the master pattern as a basic concept, which is really good. That's a great way to get started. But over time, as you see this pattern play out over and over and over again, you notice these certain little characteristics that you can form these niche strategies around. So that's really what this is all about, is just taking it one level deeper. So I'm going to start this off by talking about the very first characteristic of the master pattern I ever noticed. And this was over 12 years ago now. It's called the multi-leg expansion pattern. So what is that? The multi-leg expansion happens when there hasn't been enough accumulation of inventory to fuel the bank's distribution or trend phase. Think about the master pattern as a whole. We have an accumulation or a contraction zone. We have an expansion when it leaves that contraction, and then we have a trend to higher or lower prices based off of the bank's previous accumulation. So that's how it works, right? But what happens when we leave a contraction box and the market doesn't immediately go into trend? That's what we call a multi-leg expansion. Here's what it looks like. It starts, as the pattern always starts, with fair market value, that contraction phase. But a characteristic of the multi-leg expansion is having multiple expansion legs. It looks like this. You have an initial breakout on number 1, and then it whips down to number 2. That covers the high and low of the contraction or fair value zone. Then you go up to number 3, down to number 4, up to number 5, down to number 6. This is what we call a multi-leg expansion. I think it's pretty much speaks for itself if you look at the pattern. Going on to our next bullet point, this type of price action also signals mixed sentiment on the higher time frames. Because if we are going to break out of any range in general, who needs to be behind that breakout in order to make it sustain? Who's going to hold their positions longer and stabilize that new market direction? It's the higher time frames. This also plays right into the distribution phase because you need those higher time frames to come in and add demand to the market or add supply to the market to stabilize the next trending move, whether it be up or down. So if the higher time frames aren't on board, that multi-leg expansion is going to keep expanding. Bullet point number 3, the market will remain in a multi-leg expansion until price has clearly gone through the trend phase and establish a new contraction and expansion point at higher or lower prices. This is where we get into the strategy part of this pattern. And it's really an if-then statement. If the higher time frames are not interested in actually making the market break out, if the banks have not completed their accumulation process, then the market must still be in a multi-leg expansion. And that means that you can treat it as such. This is key to understanding overall market environment. If you are in a whipsaw market environment like this, it's best to know that going in so that you don't get beat up, because a lot of people lose a lot of money in this market condition. So part of understanding this and adding this to your strategy may be simply protecting your capital while waiting for the trend phase to present itself. Now that you know all about multi-leg expansion patterns, the next evolution of that is intra-cycle communication. So let's take a look at that. What is intra-cycle communication all about? So as the name suggests, this is all about cycles within cycles. So this is the idea that more recent cycles move in fulfillment of larger, older cycles. Now, let's not make this more complicated than it needs to be. If you are looking at, let's say, a daily or weekly chart, and you spot a predominant feature of the master pattern, and it could be a multi-leg expansion, is seemingly forming on that weekly time frame, then by default, all of the cycles on the lower time frames, let's say the daily, the 4 hour, the hour, are going to play out in fulfillment of the overall multi-leg expansion that is happening on that weekly chart. That's what we see here. You can see the green 1, 2, 3, 4, 5, 6 showing us that multi-leg expansion. But do you see the inner cycles within that multi-leg expansion? Starting with the first red box, you see that has a 1, 2 breakout expansion leading up to the next box. Then you have another 1, 2 multi-leg expansion leading up to the third red box, and then so on and so forth. But these boxes are simply fulfilling that which has already been determined based on the cycle of the higher time frame started by that first green box way back on the left side of the slide. And if you've been following us for a long period of time, then you're no doubt familiar with the basic strategy, which is the idea of trading in the trend phase and using the expansion phase on a lower time frame to get a good, strong entry into that existing trend. That's simply what we're talking about here, and that is the most powerful form of using intra-cycle communication. It's understanding on a very high level the characteristics of the master pattern, being very familiar with what that cycle looks like overall, and then predicting where it's headed on the higher time frame and using the default fulfillment of lower time frame cycles to execute your trading plan. This next one is a very powerful insight that comes from understanding the master pattern as a whole, and that is spotting efficient versus inefficient markets. Why is this important? It's because all the best money in the market, the easiest money to make, is made in inefficient markets. Those are trending markets. So let's quickly look at how the master pattern shows us efficient versus inefficient markets. An efficient market simply means there are many willing buyers and sellers at that price range. This translates in the master pattern methodology to the contraction phase. That's the tightening of the market. That's also what forms fair market value, because buyers and sellers are agreeing on that price. That's why it isn't moving. It's why it's staying right there. By understanding the master pattern, we know that when the market's efficient, that it's about to become inefficient pretty soon. What do we call that? We call that the expansion into the trend phase. And that's what it looks like. Again, this is very basic, but very powerful. Where is the money made? It's made in the inefficient markets. What's an inefficient market? An inefficient market is when supply and demand is skewed. There's too much supply in the market or there's too much demand. It's not weighted evenly. And when it's not weighted evenly, it creates opportunity. That's where the only opportunity comes in trading. So we want to be very keen on understanding when the market is becoming inefficient. And by understanding the three market phases, the master pattern, those cycles, we can lie in wait for that inefficient market to present itself and then attack it, because that's where the money's made and that's where you want to be trading. Another way you could think about efficient versus inefficient markets and the market in general is like lungs breathing. It's like you take a deep breath in, you go, that's like going into the contraction phase. And then when we go into the expansion phase, it's like exhaling, letting it all out. And then you take another breath. The market contracts, expands, efficient, inefficient, efficient, inefficient, and over and over and over again. It's up to you to understand that and align yourself with that rhythmic breathing. And if you're aligned with that rhythmic breathing of the market, then when the market re-enters that contraction or that efficient zone, you'll expect it, and then you will equally expect the inefficiency that is coming right after that. So what does this look like on the higher time frames? Simply put, efficient markets have candle range overlap, meaning a lot of candles will stack simultaneously together, overlapping the preceding candle. Inefficient markets don't have overlap. So you can see right here, we go from an efficient market at the top, we have that gap candle down, that's an inefficient candle, and then it goes back into an efficient market. So you can spot these on your lower time frames and your higher time frames. When the stories make sense between the two time frames, then you typically know how you want to attack the opportunity that's at hand. The next insight I'm going to cover with you that's come out of understanding the overall master pattern methodology is what we call order block projections. Now this one is a little more advanced. So in ATS, we use order block projections to set price extensions and projections of where we think price is going to reach to, mostly for profit-taking targets. Now, you might be thinking, well, isn't Fibonacci the same thing? No. Order block heights are set by the banks themselves, by the bank's range. Fibonacci's can sometimes be set arbitrarily based off of any given high or low. So we're setting our expectations based on the bank's organization of market framework and range size. An example of this, if the bank allows an expansion range to grow 45 pips in total height, then we can reasonably expect that the trend phase will be at least 45 pips from the confirmed high or low. Now, let's look at a detailed example of how this plays out. Like I said before, this one's pretty advanced, so you may need to rewind this specific part a few times to totally grasp this concept, but it's worth it. If you could learn how to spot the expansion range on your chart and map out the order block projections, they provide amazing profit targets. Let me show you what I mean. So as with all things with the master pattern, we always want to figure out the direction of the higher time frame. In this case, we have a weekly chart. And if you see the red line, we're specifically looking at the first confirmed downtrend candle to the third confirmed downtrend candle. Let's see how the hourly chart traded inside this weekly price action. Starting with the contraction phase, you could see that we went into the expansion phase, traded down to the low, and then came back up and took out the swing high liquidity point above value. We've reached the first point in this expansion cycle on the lower time frame where we can now accurately map out our first order block projection. How do we do that? It's very simple. If you look at the swing high liquidity point that we just came through where that red X is, we simply want to measure down to the confirmed swing low point. As we do that, we take that exact measurement from the swing high liquidity to the swing low liquidity, the confirmed point, and measure that exact distance to the upside. Now that we have our first order block projection mapped out on the chart, why is this level important? Why do we come up with this? And it all goes back to the theme of our lesson, understanding advanced theory and characteristics of the master pattern. One thing that became clear to us over time is that the master pattern establishes what we call an expansion range. That is the highest point of the multi-leg expansion to the lowest point. In this case, this is the confirmed expansion range from the swing high liquidity that we just came through to the ultimate swing low of the cycle. The cycle started at the start of that blue box. So it's the low point to the high point. What we noticed over time is that the master pattern always, not sometimes, but always travels a minimum distance of 100% up or down of the expansion range size. That is where we came up with order block projections. Now, I know you may have heard of order block this, order block that. The way we look at order blocks is that they're neutral. The order block is all the accumulation of orders inside the block, which is basically another way of saying the expansion range. That's order blocks to us. So this is a forecasted projection of the 100% move, the 100% deviation that is eventually going to take place. It will. It always does. You can 100% count on it. So what does this mean for actual trading and strategy? Well, let's look at the rest of the story play out here. As we can see, the market continued to trade above the swing high liquidity where that first red X was. But what didn't happen? It did not get to the order block projection. What does this mean? Well, a failed attempt to trade through the high of the order block projection shows lack of bullish institutional intent. Think about it for a second. I told you that the market will always eventually travel 100% minimum of the distance of the total range size. It failed to do that. We could come to the conclusion that there's not a whole lot of bullish intent in this market. And what does that mean? It's another if-then statement. If it's not going long, it must be coming back into the range and potentially going short. And that's what happened here. Trading through the expansion cycle low confirms a new range size and order block projection. This one is significant to track because it is in line with the overall trend. It will provide you with an exact profit target to trade to. Remember, the weekly is bearish. We have already established that. So we have a directional bias to the downside. So we're getting a lot of clues here. It's not hitting that upper order block projection. That's significant, and we really don't want it to because we want to see that the market is still in line with the higher time frame money flow. This clearly shows us that. But what happens when we hit that low point? we got that new X at the swing low liquidity. That gives us, it confirms a new range size. Now that we have a new confirmed range size on the expansion, we get to put in our next order block projection to the downside. How do we again come up with that measurement? We go from where the swing low liquidity is, where that red X is, that exact price, and we want to measure up to the confirmed swing high point of the overall range. And keep this in mind, we're not going to the old order block projection, we're going to that confirmed high point. We're going to take the exact measurement from that high point down to the swing low liquidity and project that 100% to the downside. That will be your new order block projection price. Again, why is this one more significant? It's because this one is now in line with the higher time frame trend. So we can expect that as long as the higher time frame trend stays intact, there is a very, very good chance that we are going to hit all the order block projections to the downside until that higher time frame trend runs out of gas. And that's exactly what happened in this example. The market traded down through that swing low liquidity, went sideways, got pretty choppy, but ultimately fulfilled the order block price. It ultimately went down there. So if you understand how to put order block projections into your chart, you could come up with some extremely accurate profit targets to shoot for that will almost always hit. And usually these markets can go many multiples further than what the order block shows. So this is just a great initial profit target to aim for. I briefly want to show you how we took concepts like the multi-leg expansion and order block projections, translated those into code, and implemented them into our overall strategy. So we're looking at our software right here. You could see that we have our contraction boxes right here, but you see how we have these numbers 1, 2, 3, 4, 5, 6, 7. That is showing us the multi-leg expansion pattern as we discussed earlier. These red lines are showing us the resulting order block projections from the multi-leg expansion. If you look over here, this is our weekly chart, just like the example we just covered. Right here through this period, you can see we were confirmed long on the weekly chart. That means the higher time frame money flow was going up. If we look at right here, we have our 1 hour chart on euro dollar. So what does this all mean? Well, we're only looking to trade long. We're looking at fair market value to make sure that we are trading below that to know that we are getting a strong entry point. But as we find entries below fair market value, with the order block projections, we know, based on what we've just discussed, that there is a very, very high likelihood that we're going to travel 100% order block distance to the upside. We know it's 100% going to happen whether it goes up or down, but because the higher time frame money flow is going up, we're only looking for the order block projections on the upside to plan our exits. So you could see as we came through right here, we came through the swing high liquidity point, we immediately got a 70.8 pip order block projection. That's 70.8 pips from the swing high to the order block projection. We know very high likelihood we're going to hit that level. So as you're positioning yourself down under value, when we come up through value, we get that. We're trying to trade to that farthest one. You can see that we hit that to the pip. As we pulled back off of that level, we formed a new fair market value here. We're only again looking to the upside. You can see that we didn't trade down to the lower one, showing that there's not a whole lot of bearish institutional intent. That's good to see. Then we trade back up through and we end up hitting that 36.3 pip order block projection right here. We also got a new cycle right here. Same thing happened. We came through the swing high liquidity, got another 34 pip order block projection, and we eventually hit that on this candle. And then we had our eventual rotation in trend, which may be a full-blown reversal here. We'll have to see how that plays out. But this is just an example of how we've taken those concepts of multi-leg expansion, order block projections, taken those little niche strategies that can be formed within those concepts and applied it to a real-world use case. We have traders, thousands of traders all over the world now relying on these indicators to give them solid profit targets and projections and help them accurately identify what's happening in the market, what the true environment is, so that they could stay prepared and take advantage of these great opportunities. So what's the takeaway from this lesson? The master pattern framework is based on the root cause of market movement. I think you should understand that by now going through these tutorials. Because of this, you can create all kinds of strategies and approaches from this framework as I've demonstrated in these 4 examples. Now the only thing left to consider is what strategy will you use the master pattern framework to create?